Ladies and gentlemen of the crypto space, we're live on a Thursday, September 11th at 5:29 p.m. Today of all days, a day of remembrance. Myself, I was just going into college on September 11th, but I'm not here to talk about our horrible past and our painful memories and whatnot. I'm here because, as I said, today of all days, the indicator of indicators, ladies and gentlemen, is rolling over. The indicator we have been waiting for years. The indicator that nobody talks about because nobody understands. Everyone's looking at the PPI, the CPI, and whatever the hell stupid number comes out of the Fed. Now, most of it is trailing. They respond to information. But when you see numbers like this in publicly available data, the volatility indicator of money, this is a forward looking indicator of the most important thing that matters. And it's not a Fed number, it's not a statistic about the economy, how screwed everyone is and how broke everyone is. I reposted some things about that because obviously the vast majority are broke, the vast majority are screwed. The Fed themselves is even screwed, a rock in a hard place. But hanging your hat on a stupid number coming out of the Fed is a waste of time. It's not going to get you the information you need. It's basically doing the same shit that everyone does, looking at the same information that everyone looks at. And for the last years, I've been harping and trying to teach about money and my reductionist inspection of the most important characteristic of money. How much of it is there? How much money is there? And how is money printed? And who prints the money? And I've given analogies and comparisons. You folks might know the Aave analogy and volatility of maybe Bitcoin on Aave. And if your health factor is at a 2 and Bitcoin's going between 80 and 120 grand, you're probably not borrowing more money. But if Bitcoin has been $110,000 for the last 4 months, this is a hypothetical, and your health factor's out of 5, you're probably going to borrow more money. The volatility of the collateral, the volatility of what you're borrowing money against is what means everything, especially given the way the world works. The world's largest collateral, the collateral that drives the world, is US government treasuries. Simple. Reduce the equation to something simple and make a large scale inspection. I know real estate, big business, and people borrow money and HELOCs and mortgages. Gives a shit. US government debt, the euro dollar system, and how dollars are liabilities and how banks deposit liabilities in a person's account when they post collateral. And the best collateral that the banks want are US government debt instruments, US government debt securities, because they pay face value in dollars. If you post $1 million face value worth of US government 10-year bonds or what treasuries, well, long duration, the bank will surely lend you a $500,000. They'll probably lend you $995,000. The worst case, that depends on underwriting. Anyway, point being, at worst case, you don't pay them. They're going to keep your collateral and they're going to get paid face value. They're going to get paid every dollar when those bonds mature, when those treasuries mature. So there's almost no risk. It's a risk-free collateral because the government, US government, is going to nominally pay the amount of liabilities that that bank deposited in the borrower's account. So it's all about the underwriting and the leverage, loan to value. So if the collateral volatility, if the treasury volatility is low, the bank's like, all right, borrow some more money. The Ave health factor is at a 5. And the bank's like, all right, we just bought, $500 billion worth of assets on the books. And I know we got to sell the liabilities because that's what it is. Double entry accounting. The bank has to balance their assets and liabilities. So if they bought this amount of assets and add to the books, well, they better go out and sell some liabilities, which is either get bank deposits or issue credit. Okay. So that's the reason why when the collateral volatility rolls over, we are looking at a forward looking indicator of the global dollar currency supply setting up to expand. Because now, right now, if the number on the move indicator keeps going down, the banks are like, oh, what's the expectation? If they expect collateral volatility to continue to roll over, that means they're readjusting their books in favor of issuing more liabilities because they want to buy the low volatility collateral using liabilities. They want to issue credit because that's their business. This is a setup where the global banks are going to actively try and sell dollars because that's what credit is, the activity of selling dollars. And we're at 75, ladies and gentlemen. Okay, so the point of why it's an emergency stream is because we have been talking for years. And in 2020, December 2020, right about here, December 2021, I said 20. This is where everything started to roll over because this is where the market sniffed out that volatility was going to spike, and it did. And it spiked up to 139. Then it did all this insanity, and it finally did a blow off top to 198. And we have been finally getting volatility under control until today. Literally, this is the day. This is why the emergency stream has been called, ladies and gentlemen, because we have been waiting for today for this indicator that looks at the future price of money in uh, in SOFR, in the contract spreads, and the volatility in the price of treasury instruments, and whatever the composition of the move indicator is, the value has finally rolled over, ladies and gentlemen. You don't know how big this is because this is literally not even about big. This is everything. Folks are like, "Oh, is the Fed going to cut?" Of course, the Fed is going to cut because the collateral volatility is rolling over, and they need to adjust the plumbing to prepare for the influx of dollars that are going to be injected into the system as the banks are forced to sell dollars because they need to add liabilities to their books to balance the double entry accounting with the assets that they got on their books. They got to balance the books, ladies and gentlemen. Now, obviously, you get volatility spikes, and then all bets are off. 145. Whole world is over. But the point is, once the market sniffs out that you're going to get a lower low and a lower high for a period of time, there's your market, there's your rally, there's the alt season or whatever you want to call it. It's not. This isn't about events, black swan, white swan, or whatever the hell people want to call it. This is about a period of market condition and what the likelihood of what's coming is going to be. So if the directionality persists on the move indicator down into the 70s, into the 60s, and you get the lower high and the lower low, which is literally what happened in 2020 and 2021, right? That's literally what happened in 2018, or rather said 2016, 17. Here's your 16 coming back below, breached through the 82, rejected. Then in 17, it finally rolled over down to 44. There's your 16, 17 crypto cycle. And then obviously 20 and 21 is just there's insane. And now we're literally here. Folks, I've looked at the wrong information this entire time. Anywho, fortunately, I've shared the story a little bit, and hopefully more, rather than less people have been able to prepare. And the preparation is as simple as the three rules. All you had to do was buy more assets over time, and you had years. You literally had years to DCA and to build a well-structured portfolio with intent and reason and logic and balance, feng shui. You hung the paintings in the right places and picked the proper wall colors, and you built something nice. I hope you did, because it's about to be game on. I don't do emergency streams, but this tick, this, this, this This is emergency stream. There's nothing else. There's nothing else that I look at. Given the way I look at the system as a reductionist, I wanted to find and understand what is the one thing I need to look at of all things out there. What do I need to look at to understand that we're on the precipice, or the has a negative overtone? We're on the verge of the market conditions that we've been waiting for. It's this. It's this, ladies and gentlemen. And to top it off, we have confluence. We're catching the bid in the 10-year. We punch through the 4 to the downside briefly. We'll see what happens. But the DXY is below 100, breaching the 100 SMA and the weekly to the downside, retesting and getting rejected. You punch that lower low down to 96. There's your confluence, ladies and gentlemen. You see the move indicator rolling into the 70s, reach down into the 60s with the DXY 96 heading towards the 200 SMA and the weekly, and you're going to see some weird shit happen. You're going to see some weird shit. That just is what it is. Okay. So now that I got the excitement, all that excitement out of the way, I don't do emergency streams. I just don't. It's stupid. But when it really is an emergency and I have something to be excited about, all right, fine. I mean, we've been waiting for today almost 4 years. Let's go to the day. Let's do to the day. How long have we been waiting for today? Today, September 11th, 2025, of all days. So the breach, the precursor, the end of the market, when the Fed started to respond, when the Fed started to respond to rising collateral volatility, December of 2021. So what's the gap between the days? Uh, date range between here and here. Ladies and gentlemen, we have waited 1,365 days. We have spent 1,365 days executing rule number one: own more assets. Talking about what that means, what kinds of assets, creating new rules, like rule number two: know when to stop buying assets. Simple rule. You don't want to buy a premium. You want to buy something cheap. You want to buy something on sale. You want to buy a discount. You don't want to buy a $50,000 car for $100,000. That seems pretty wrong. So you want to check out what the historic price action is. And that's what this data is, chart data that we look at. You get a sense of what the price of things should be. You don't want to overpay. So hopefully over the last 1,365 days, we've bought assets at relatively discounted prices. My general sentiment is if you bought anything past November of 2024, you started to not get a discount anymore. So anything up until about November of 2024, yeah, those were your biggest discounts. Probably like September, October, November. If you bought in those 3 months of last year, probably have the biggest discounts. But not always. Not always. I mean, look at Aerodrome. Aerodrome bottomed in April of 25. God, I think whoever got, so obviously there's folks that have 10-cent arrow, 10-cent and lower, airdropped arrow from Velodrome. But otherwise, unless you're the original folks, if you in April of 2025, if you got a bag there and got flight school, that's the generational entry. Because this market, the conditions we're in, if the move indicator rolls over, this thing's blowing past all-time high. It's blowing past this price, this range, and that's it. And then it goes up. And and then we get to talk about top, and then we get to talk about where bottom is, and we're not there yet, but it'll blow past all-time high. It goes way past. That's a whole separate conversation whether current pricing is good. That's a whole nother story. But the whole point is the last 1,365 days, we had the opportunity to buy as many assets as we could at hopefully the best price that we could. Cheapest price of Curve was in August of 2024, way before in November. Had some opportunities for some decent numbers in 2025, but not 18 cents. Woo! 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 We are 400% off Curve lows. And this oh, the chart. I mean, look at the aerodrome and the curve chart. These are insane charts. Absolutely insane setups. Um, all right, that's enough. We talk about what assets we like twice a week, Mondays and Fridays. So y'all know what most of my portfolio is composed of, and I'm pretty sure most of your portfolio is composed of, rule number three, type assets. Rule number three is fuck you, pay me if you do not know the third rule. And that is the qualification of a superior asset, an asset that actually pays you for owning it. And gold 36.73 on the futures. Well, hey, look at Russell 2000. Russell 2000 is about to pop, and that's a very similar ceiling. Look, November 2021. Oh, I mean, this literally has like Ethereum written all over it, which is really weird. That's a little bit weird, ladies and gentlemen. I'm just saying. All right, let's go through some commentary. Good morning, Cap. Yeah, yep. Emergency stream. Emergency stream it is. Critical mass here. Michael Shiad. Yeah. Last stream, if I recall correctly, you mentioned you expect V curve revenue to 10x. Can you expand, please? Okay. So, expectation. I don't have an expectation of 10x. My expectation is up and to the right. Over time, over the next 5 years, I expect revenues across my entire portfolio to be significantly higher. Multiples make sense. Probably not too many multiples, not the best to have an exuberant expectation, but if my revenue doubles or triples or quadruples, that's pretty crazy. So to me, most important thing is to have reasonable expectations. So, what's the backdrop of literally anything systemic, anything infrastructure in crypto fintech to increase its cash flow? Stablecoin supply. It's literally just follow stablecoin supply. I mean, Curve also has a different narrative because it's a euro dollar. It's literally a liability printer. Um, it is a major credit facility in crypto. It is one of the trusted credit facilities in crypto. And the potential with yield basis, the potential with FX. What if there's $1 billion worth of CRV USD running around? What if it starts to really grow and there's $10 billion? Then all transactions go through CRV-USD, and then folks are arbitraging. They're literally minting CRVUSD by borrowing merely for arbitrage opportunities. So things start to get weird. So that's the cash flow for these CRVs. Other than transaction fees, it's LAMA lend and CRVUSD lending. It's not going to be yield basis or FX, but those are supply sinks. Those are what create and expand the demand for CRVUSD supply exponentially. Hope that helps. Bob Rob reposted the stream. Thank you. It's an emergency stream, ladies and gentlemen, an emergency stream. Soon, good evening, Captain. Much a pleasure. Hope all is well. What rich people going to do in Western countries if a revolution starts? French Revolution will happen. People ready for that? Are people too lazy to take to the streets nowadays? It's not something really to consider. That's like a prepper. Do you have a bunker? Do you have food stores? I don't know. Do you have shotguns and ammo? That's a separate conversation. That's separate and apart from capital management. And my 2 cents is that's why I came up with the three rules. The three rules are separate and apart from preparation for incivility. Because to get to incivility, you still got to get past the government's mandate. The unspoken mandate of all governments around the world is to finance social civility. So, especially in the larger countries, especially in the countries that have access to credit, or the U.S. that doesn't need the credit, it could just manifest dollars. Uh, there's a long way to go before you get to social civility because you just airdrop capital and that tends to calm things down a period of time. My 2 cents, but it's neither here nor there. You either an investor is also someone who hedges, and if you're hedging with regard to prepping and you have food stores and what, fine, whatever makes you sleep at night. Because in the end of the day, this is all about living, and you're not living if you can't sleep at night. So if you can't sleep at night because of the way you invest financially, there's some issues you got to work on. If you can't sleep at night because of the way you invest with regard to incivility or unrest preparations, you got some shit you got to figure out. If you sleep at night, you're doing what you should be doing as a human, and you pretty much are winning as a human. You need to be able to sleep at night. You have to have peace of mind. That's why I talk to everyone about the sauna and shit. You're not a good investor, folks, unless you can sit in the sauna for 20, 30 minutes, unless you have the capacity to clear your mind. You're at peace, you're at ease, you make decisions without anxiety and pressure and frustration. Hope that helps. Joel, much a pleasure. So they gonna cut because the volatility down on the debt is taken opportunistic to cut to secure cheap money. Well, you know, leads and lags. Does the Fed can they say that Fed basically follows the 2 year, and the 2 year is low. So who sets it? Does the Fed set policy or do they react to policy? It's a chicken and the egg is my point. It's who created who? Did the chicken create the egg or vice versa? You'll get a different answer from whoever you ask. And the point is, cares if they cut? They're gonna cut because the damn collateral volatility is rolling over. So the market's pricing in that they're gonna cut, and it's just all in preparation. It's all connected, and it's leads and lags. What it's kind of like manifest destiny or the paradox stuff, where the future kind of creates the present. The future conditions that the market is preparing for is creating present conditions, and the present conditions are in turn what create the future conditions. I hope that makes sense. I think that one does. I think that one's going to ring home for all you time travel buffs out there. I I have learned something very important in my career as a software developer. When I have a bug, sometimes I don't give a shit why the bug exists as long as I can fix the issue. That is just something I that has rang true for me for quite some time. So yeah, I don't care. I don't care why the volatility came down. It did. And it's telling us the market condition. It's telling us how the world is behaving. And that is for us to take as data, signal through the noise. And this is the signal that matters. because this is the precursor, the forward looking indicator of currency supply expansion of the currency that matters, dollars. Why Raul and Mike looking? Yeah, that's exactly who to Mike. Mike Howell talks about the move indicator all the time. Raul talks about Mike Howell and the move indicator all the time. He doesn't really talk about the move indicator. He likes his trends, and he'll look at like total three, the same thing that I look at. He looks at this as basically an ascending triangle, and this is to me, it's just a level. This is a look. It's the same thing as the IWM. It really is. Look at that. Peak, 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 and then you look at total three, it's peak, peak, peak. Oh, it's literally the same exact thing. So when this thing breaks, man, it's just gonna be weird. That's exactly why they look at. We all look at the same things. We all tell the same story, just from a slightly different perspective. Why Raul and Mike talking about their global liquidity charts? No, they are. Mike Howell talks about the move indicator all the time. Uh, period. This is literally Mike Howell's story. I mean, when I first heard, I never heard of Mike Howell before a couple of years back, and when I first heard his story, I was like, "Oh shit! What do you know? There's someone out there that's older than me that sees what I see. This concept of liquidity and currency supply, and he definitely knew more about refinancing. And I like the way he frames it. The capacity for the system to refinance is really the liquidity rather than dollar supply, and that's very interesting. And I appreciate that. That comes from his experience, but if you asked him about the move indicator and what that means for the capacity to the of the system to supply currency or expand the currency supply, he'll give his story, but it's basically going to be the same thing that I'm saying. About shit's about to get frisky, ladies and gentlemen. You could be sure about that. Can you guys explain again? Oh, no, no, no. I can't explain all of that again. Fortunately, YouTube records all this stuff and there's a rewind feature, and X has the recording also. My man. Money about to enter the system. No, the forward looking indicator of the system being in a position to want to print money. It's like the Aave story that I've told time and time again. Bitcoin's been sitting at, let's say, $110,000 for 6 months on Aave, and your health factor is sitting at 5. You're probably going to borrow money. But if your health factor is sitting at 2 and Bitcoin's going between 80 and 120, you're probably not borrowing a lot of money. So if the volatility comes down and the collateral appreciates, which is the 10-year and the yield's rolling over, if your Bitcoin goes to 200,000 and your health factor is at 15 and it's sitting at 200,000 for like 2 months, you're going to be getting credit all over the place. You're going to be doing carry trades all over the place, and all that shit you remember from 2021 with the Aave whooping, whooping, whooping. It's going to get weird. And that's what happens when collateral volatility is low. Bonds are the collateral for dollars. When collateral price goes up and volatility goes down, can create a lot of dollars, global liquidity. Yep, simple as that. Simple as that. So the precursor is these three pieces of data: move to 10-year yields and DXY. That's my distillation of how I see the most important high level 10,000-foot view of everything. The dollar comes down, takes pressure off of the currency markets, and gives the dollar printing market a capacity to come online. Once the printing capacity, which is basically the Eurodollar market, comes online, that just pushes the dollar further down because now you could just borrow dollars instead of buying them on the forex markets. So the dollar coming down, the DXY coming down, uh, it's the paradox thing again. The DXY coming down allows in the future for the DXY to come down, which in turn creates the present. It's that paradoxical what chicken and the egg phenomena. So the 10-year yield appreciates, yield comes down. You see this thing at 3.5, that's your Bitcoin going up. And then move coming down. So move coming down means instead of Bitcoin going between 80 and 120, it's going between 105 and 106. Lower volatility. Nothing to worry about. You're not on the verge of liquidation at all because it barely moves. and you're at a 5 on Aave or a 10 or a 15 on Aave because Bitcoin just ripped to 200, 250. Oh, you're at a 15 on Aave, right? You're going to start to borrow money. So when the world does this against the pool of global collateral from the US government securities, there you go. There's the increase in global currency supply afforded by commercial bank liability deposits, then balancing the double entry accounting books in what's called the Eurodollar market. Bing, bada, boom. Mixed passive viewing experts. Yeah, all the folks on social media, they're like, oh, the Fed's going to cut rates now because the CPI is down or the PPI is down. Means nothing. Means nothing. Money about to be created. Money on is increasingly likely to be created because the conditions are more favorable. And that's why the Aave analogy is so important for folks uh, that are crypto native. They're like, oh, all right, I've borrowed on Aave before. Hmm. Well, what if I get liquidated? I probably should borrow less. Oh, I should probably not have a health factor of 1. I should probably have a health factor of 5. But my Bitcoin just went up 2x on the money. Now my health factor of 5 just turned into 10. I have a health factor of 10. I'm probably not going to get liquidated unless Bitcoin chops in half. That takes a lot of volatility. For the Bitcoin price to get chopped in half, that's a lot of volatility. Well, Bitcoin's not that volatile. It's not that volatile. Right, not right now. Oh, I'm going to borrow. Oh, I borrow. That's the credit creation process. So if you're not afraid that your collateral is going to drop in value, you borrow. So that's why the Aave story tells you how the world creates dollars using US government debt as collateral. Very hard to know which components are more important than others. Will Bitcoin price vol be an indicator for global liquidity? Do we have numbers on that kind of stuff? Bitcoin price vol? Nah, no, because nobody, that's not a component of global currency. No one gives a shit about Bitcoin. In the global currency supply world, I mean, you're talking about 300 plus trillion dollars. Bitcoin is not part of that right now. It's U.S. government debt, and yes, obviously you have the whole Brent Johnson, Luke Gromen, you know, Rick's currency. What the fuck you want to talk about? Nothing's changing right now. As Luke Gromen talks about, change start. As everyone talks about, change starts at the margins. So change starts slowly. The whole system doesn't change overnight. It doesn't change over 5 years. It changes over 10, 20, 30, 40, 50 years. So even if global reserves are adjusting towards gold, yeah, okay, great. So, but the point is, right now, 2025, U.S. Treasuries are still the collateral to borrow or to collateralize dollar debt, to print dollars, get dollar credit. The way the core of the system works, even though in the backdrop you got Luke Groman's story, even though in the backdrop you got Brent Johnson and Milkshake, where the end is with DXY at 1,000, and all there is dollars left, and nothing else matters. So even in his backdrop, because that's the future, and Luke's talking about the change starting at the margins, and, and we all tell the same story, and that's all I do is just aggregate it into a story that's useful for investors in one of the most volatile markets on the planet. And I use the story to help myself identify financial opportunity because these are fintech banking products that we deal with in these crypto markets. Therefore, the way global currency supply works is manifested in these crypto markets the same way. These products are no different, except these products are better because they're deterministic and immutable, which changes the entire equation. Anyway, hope that helps. Curve starting to pump as we speak. That's right. 81 cents looking good. Arrow up at 122. Coinbase narrative is insane with the arrow. Curve, I think, is just going to be so lovely with yield basis. Just wild to think about this stuff. All right, and a pleasure. Fair enough regarding the vol down. Love the software analogy. Hope it helps. Thin air, hello, Cap and chat. Much a pleasure. Afternoon chat today, Cap switching it up. No, no, not an afternoon chat. Today is the emergency stream. This is currently an emergency stream because this is a condition we've been waiting for 3.5 to 4 years. 1,365 days we have been waiting for today's stream. That's what today is. I don't do emergency streams, but today is an emergency stream because that's how long we've been waiting for today's stream so that I could stand in front of you on camera and say, holy shit, move is down at 75. That's what today is. That's big. Actually, it doesn't really matter. Just keep DCA. Yeah, well, it's rule number one. That's why I'm not too comfortable with the rule saying no one to stop owning more. Well, if Bitcoin's it's at 114. If Bitcoin's sitting at 500 grand in the next 3 months, probably could, I mean, yeah, you don't have to DCA at the same rate. You could slow it down a little bit. You're literally buying 60% less Bitcoin for the same amount of money. It's like it's expensive relative to today. You adjust to get a sense of the relative pricing. Oh, starting to get expensive. And yeah, that's the conversation that we'll have about when is top coming. I mean, you could just DCA the whole time, and that's fine as long as it's a nominal, reasonable number. But there's reason to execute rule number two. I mean, listen, if Arrow's coming in at $20, you probably shouldn't be thinking about starting a position, an investment. People literally buying 90% less Arrow for given as compared to buying it today, and it's like 95% less Arrow as compared to a couple months ago. So timing makes a big difference with regard to investments. Um, DCA and these larger type of investments are very dependent on portfolio size and the amount of capital available. DCA always works. If you're a small investor, a couple $1,000s, a couple $100s, $50, yeah, DCA. DCA until you get a better sense of investing. But for example, my 2 cents, if you're pulling in like two, three, $4,000 a week and you could accumulate $20,000 a month and you could accumulate, 1, 2, 3, 4, 5% of your portfolio in cash in 3 months. Okay, you could talk about $50,000 investments. I'm going to take a position. I'm going to buy something. And you probably want to buy it at a cheaper price rather than an expensive price. So these are different considerations for different size portfolios. Very important to respect the size of the portfolio. But I got the nuance, I suppose. Yep. So basically, the Ave of the real world is about to see some activity. Yes, yes. It's called the Eurodollar market, which is where banks have assets and liabilities, and banks buy assets, which means they need to add liabilities to their books. To add liabilities to their books, it's not like bank deposits really work. Because if you take a bank deposit and now the bank is receiving cash deposits, the bank's just going to buy more assets. They got more assets. So how do you get just liabilities on the books? Credit. You got to lend the dollars into existence. That's what a bank deposit is. The bank owes you money. So that's how the bank just adds liabilities without additional assets. They don't want the deposits, but they want us to issue credit against collateral, HELOC, mortgages, credit cards, and that's how they get the liabilities to balance the books. And volatility, health factor, liquidation risks is also about, good investor hygiene. How much leverage do you have? So on and so forth. Basically, yes, what you're saying is exactly the case. Hello, thin there. Yes, indeedy. Yes, indeedy. Okay, I'm gonna keep it short. Probably gonna still do a stream tomorrow. Can't promise it because this was a nice emergency live stream on the day we've been waiting for 1,365 days. But I appreciate all of you joining me today on a quick Thursday afternoon. All things considered, crazy shit. Yesterday's events, today's notable holiday of sorts of remembrance and whatnot. Fun fact, my father, I was young at the time. Clearly, that was 24 years ago, and I was going into college, but my father was in the air. May he rest in peace. He was a business owner back then, and he was coming home from Europe, and they diverted him to Canada. And he had to take like 5 or 6 buses. It took him 3 days to get home from Canada to New York at the time. And that was insane. And that was September 11th, 2001. Crazy back then. That was insane. 6:09 p.m. on Thursday, September 11th. 168 people made it to the end of the stream, and you are all now that much more rational because of it. Stay calm, cool, and collected. Let's see what happens over the next couple of days, but stick to the rules. Be smart. Things look great. Stay away from noise. Find your inner peace. You'll be a better investor if you could clear your mind and drive away the noise. I'll see you soon. Until then, peace.